What if I told you the United States government just accidentally admitted that the US dollar is failing? While every retail investor was glued to their screens, watching silver struggle at the $90 mark, something happened behind the scenes that changed the game forever. The US Mint, the sovereign entity that actually handles the nation's physical money, just updated its internal pricing. And the number they leaked? It's not just a price hike. It's a total surrender. They've priced silver at $173. That's nearly double the market price. Today, we're pulling back the curtain on the sovereign leak and why this quiet move by the Mint is the ultimate signal that the paper money system is finally breaking. For the last 72 hours, the mainstream media has kept you distracted with volatility. They want you to stress over the small dips and the chart patterns. But while you were looking at the digital ticker, the physical world moved. We have confirmed reports that the US Mint has quietly repriced the proof American Silver Eagle to $173 and the uncirculated bullion version to $169. Let's pause and let that sink in. The spot price on your trading app says $90. The government AS-owned shop says $173. That is a nearly 100% premium. In any other market, this would be called a systemic collapse. When the entity that literally stamps the coins refuses to value them at the market rate, they are telling you that the market rate is a lie. Why the Mint is front-running reality. Now, the skeptics and the paper gold bulls will tell you, oh, the Mint is just closed for inventory, or sales are suspended so the price doesn't matter. But I'm here to tell you that it matters more than anything else right now. Think about the logic. Why would a government agency, which is already struggling with a pricing backlog, go into their secure servers and double the price tag? They aren't guessing. They are front-running the reality. They know that when those sales windows eventually reopen, they cannot afford to sell silver at $90. If they did, they'd be looted of their strategic reserves in minutes. By setting the bar at $173, the US Mint is sending a flare into the sky. They are signaling where they believe the actual clearing price, the real price, is headed. The two-tiered reality. We are now living in a two-tiered financial reality. Tier 1, the paper market. This is Wall Street, where big banks swap digital contracts and pretend silver is worth $90. It's an illusion. It's a derivative game. Tier 2, the physical reality. This is where the Mint, the industrial buyers, and the smart money live. In this tier, if you actually want to touch, hold, and own the metal, you have to pay the true price. This $80 a gap isn't just a spread. It's the sound of a market breaking in half. When the distance between the paper price and the physical cost is this wide, the exchange isn't discovering price anymore, it's discovering insolvency. It means the banks are running out of the real stuff. But this is just the tip of the iceberg. While the Mint was changing its website, the vaults in New York were being emptied in a way we haven't seen in decades. In the next part, we were going to look at the Friday Night Heist, where 4 million ounces of silver vanished in a single day. You need to see where that metal went. While the United States Mint was busy updating its website to reflect that massive 173 price tag, a much more desperate operation was unfolding in the shadows. We've just finished analyzing the daily warehouse reports from the CME Group for Friday, January 16th. Normally, these reports are the driest part of financial news, usually showing a few thousand ounces moving here or there. But Friday's report didn't just show movement, it screamed bank run. In a single 24-hour window, over 4.2 million ounces of silver were physically hauled out of the Comex vaults. This wasn't a transaction, it was an exodus. Putting the numbers in perspective, let us put 4.2 million ounces into perspective for a second. We're talking about roughly 130 metric tons of physical silver. This isn't a retail investor buying a few tubes of coins for their home safe. This isn't even a large jewelry manufacturer restocking for the season. This kind of volume requires a fleet of armored trucks and cargo planes. This is institutional-grade panic, and the data shows exactly where the bleed happened. 1.4 million ounces pulled from the Asahi depository, 1.2 million from CNT, another 1.2 million from the JPMorgan vault, and 800,000 from Manfra. This was a coordinated, systemic raid across every major custodian in the New York network. Someone, or some group of entities, is grabbing every physical atom they can get their hands on, regardless of the cost. The smoking gun of the $86 smash. But here is the smoking gun. This massive withdrawal happened on the exact same day the paper price was smashed down to 86. Do you really believe that it's a coincidence? Do you think it's an accident that the price dropped $6 right before 4 million ounces left the building? Absolutely not. It was an engineered heist. The big banks used their paper contracts to flash crash the price to $86 for one reason: to settle their physical withdrawal requests at a massive discount. If you're pulling 4 million ounces out of the system, a $6 drop in price saves you $24 million instantly. They didn't smash the price to profit on the trade. They smashed the price to loot the vault before the door slammed shut. The death of registered silver. The most terrifying part of this report is not the total number, it is the collapse of registered silver. In the Comex system, registered metal is the stuff that actually has a for sale sign on it. On Friday, this category plummeted by 2.5 million ounces, falling to just 120 million ounces. That is the buffer, that is the safety margin, and it is evaporating. Why would the owners of this metal remove the for sale sign right when prices are hitting all-time highs? Because they know what's coming. They know about the looming strategic mineral reviews and potential export restrictions. If the government is about to declare silver a critical mineral, you don't want your metal sitting in a public warehouse in New York where it can be seized. You want it out. You want it in a private vault, or better yet, out of the country. The insiders are taking their chips off the table. They are moving metal to London, to Shanghai, and into private hoards while the public is still staring at a $90 ticker. But while the whales were raiding the vaults, the retail public was doing something even more historic, something that has trapped the biggest banks in the world in a 4 billion ounce nightmare. In part 3, we were going to look at the retail swarm and the massive trap that is about to explode. We've seen the sovereign default at the U.S. Mint. We've witnessed the professional bank run at the Comex vaults. But there is a third force in this market that is perhaps the most unpredictable of all: the retail swarm. For decades, the silver market was a quiet, lonely corner of finance, mostly inhabited by preppers and contrarians. But over the last 6 months, something fundamentally shifted in the global psychology. The average investor has woken up, and they aren't just buying. They are participating in a migration of capital that has no historical parallel. Data from the Comex letter, one of the most respected institutional firms in the world, has just confirmed a buying panic of historic proportions. Retail investors have been net buyers of the largest silver ETF, SLV, for 169 consecutive days. Let that number sink in. That is nearly 6 months of relentless, non-stop accumulation. It is the longest buying streak ever recorded in the history of the silver market. In the last 30 days alone, silver ETFs have attracted nearly $1 billion in new inflows. This isn't a flash mob like the Reddit squeeze of 2021. That was loud but short-lived. This is different. This is capital fleeing the dying bond market and the overvalued stock market, searching for a lifeboat in hard assets. But there is a tragic irony here that most of these investors are missing. Here is the danger. Most of this retail money is flowing into paper ETFs like SLV. The average investor thinks that by clicking buy on their brokerage app, they are taking silver off the market. They couldn't be more wrong. When you buy a share of a paper ETF, you aren't buying a silver bar. You are buying a trust unit, a claim on silver that sits in a vault controlled by the very banks we just saw draining their own inventory. This creates a conflict of interest so massive, it blocks out the sun. The custodian of your silver is also the largest short seller of your silver. You are essentially paying your opponent to hold the weapon you think you are using against them. The 4.4 billion ounce nightmare. Now let's talk about the villains of this story. Reports indicate that major banking giants, specifically Bank of America and Citigroup, are sitting on a derivatives book that defies logic. Some analysts estimate their gross short position in precious metals is as high as 4.4 billion ounces. To give you an idea of how insane that is, global mining production is roughly 800 million ounces a year. These banks have sold paper contracts representing 5 years of total global production. They have sold silver that doesn't exist, silver that hasn't been mined, and silver that hasn't even been discovered yet. This is the textbook definition of a naked short, and they are now completely trapped in a vice. The immovable object versus the unstoppable force. On one side, you have the retail swarm, millions of people pouring billions of dollars into the market, refusing to sell the dips. On the other side, you have the whales draining the physical vaults, removing the only collateral these banks have left. If the price of silver gaps up to $100 or $120, the losses on a 4 billion ounce short position wouldn't just be bad. They would be catastrophic. It would wipe out the equity of these banks and require a bailout larger than the 2008 financial crisis. This explains the sheer violence of the price action we are seeing. The banks are fighting for their very survival. They are trying to scare you out of your position, but the 169-day streak proves it's not working. The public is no longer afraid of the red candles. They are using them as entry points. The banks can print paper, but they cannot print metal. We are approaching the moment where the paper claims exceed the physical atoms by a ratio that triggers a total system default. The fuse is lit. The question is, what happens when the markets open on Monday morning? In the final part of this deep dive, we are going to calculate the true target price and give you the ultimate strategy to survive the great repricing. We have arrived at the final verdict. If you've stayed with me through this forensic investigation, you now possess a picture of the market that the mainstream media is too afraid to show you. You've seen the sovereign leak, where the US Mint admitted the true value is 173. You've seen the Friday Night Heist, where 4.2 million ounces were looted from the vaults. And you've seen the retail swarm that has the banking cartel trapped in a 4 billion ounce nightmare. This is no longer a theory. It is a mathematical certainty that a massive repricing event is now inevitable. The Grand Canyon of Risk. Today, Sunday, January 18th, 2026, we are staring at the largest pricing anomaly in the history of finance. Look at the numbers one last time. The paper spot price on the Comex closed at roughly $90. The Shanghai price, the real physical hub, is already trading higher, and the United States Mint has set the bar at $173. The gap between the paper price in New York and the sovereign price at the Mint is a staggering 83. That isn't just a spread. That is the Grand Canyon of financial risk. If you can buy silver for $90, you are buying an asset that the government itself says is worth 173. You are essentially buying dollars for 50 cents. But this window of opportunity is about to slam shut. The only path forward. Markets abhor a vacuum, and physics demands equilibrium. There are only two ways this gap closes. Scenario 1. The US Mint is wrong, the shortage is fake, and the 4 million ounces magically reappear in the vaults. Given the structural deficits in the 5-year mining supply gap we discussed, this is impossible. Scenario 2. The paper price on the Comex gaps up to meet the physical reality. This is the only path forward. The paper price is a lagging indicator. It's the last thing to move. The physical price leads, the Mint confirms, and eventually, the paper market capitulates. We are setting up for a Monday morning shockwave. As news of the Mint's $173 price tag spreads over the weekend, investors globally are doing the same math we just did. They are realizing $90 is a gift, and they will rush for liquidity the moment the opening bell rings. Golden rules. So how do you navigate this chaos? Here is your strategy. Rule number 1. Do not sell your physical metal. If silver hits $100 next week, the temptation to cash out will be massive. But remember the Mint price. If you sell at $100, You are giving a $73 discount to the government's own valuation. Don't trade a scarce, life-saving asset for a dying currency. Rule number 2. Ignore the volatility. The banks are wounded, but they will fight. They might try one last smash to trigger stop losses. If you see a red candle on Monday, laugh at it. It's a paper signal in a world that has run out of physical atoms. Rule number 3. Watch the spread. As long as the mint price remains significantly higher than the spot price, the squeeze is active. The bull market is not just intact, it is accelerating. We are witnessing the collapse of a 50-year scheme to suppress the price of real money. It's messy, it's volatile, and it's terrifying for those who aren't prepared. But for those who hold the scale instead of the screen, it is the greatest wealth transfer of our lifetime. The government has tipped its hand. They told you what it's worth. Believe them. The banks are short, the vaults are empty, and the clock just hit 0.